This video is brought to you by Seeking Alpha. Get a 14-day trial of Seeking Alpha Premium via the link in the description.
Anticipating a few questions on banks, I decided we should start using bank language here to describe and Charlie.
Last Saturday, Warren Buffett and Charlie Munger sat down for over 6 hours to answer an enormous range of questions from Berkshire Hathaway shareholders. But from listening to Buffett speak live, one topic that dominated the room was the current US bank crisis, as well as what it's leading to in regard to the US economy. On the topic of Silicon Valley Bank, Buffett said there would have been catastrophic consequences if US regulators had not insured all deposits, as the failure of this bank alone risked sparking bank runs across the US.
If Silicon Valley Bank's deposit had not been fully covered, what do you think the economic consequences would have been to the nation?
Well, I would just simply say it would have been catastrophic. And that's why they were covered. And even though the FDIC limit is $250,000, that's the way the statute reads, but that is not the way the U.S. is going to behave any more than they're going to let the debt ceiling cause the world to go into turmoil.
Buffett's comments follow the collapse of not just Silicon Valley Bank, but also Signature Bank, First Republic, Silvergate, and Credit Suisse internationally, and again sparked debate over just how much the Federal Reserve should assist above and beyond the pre-existing $250,000 federal insurance on bank deposits. Earlier this year, the FDIC, the Treasury, and the Federal Reserve bypassed this limit by announcing a systemic risk exemption for both Silicon Valley Bank and Signature, announcing that all deposits would be covered. It was an unprecedented move, but has drawn criticism due to the increased risk of moral hazard at the banks. But others argue that this move from the government was absolutely necessary, as it reassures the country that their bank deposits will be safe, thus reducing the risk of further bank runs. And this message to the American public is the main reason Buffett saw this move as inevitable and necessary.
I can't imagine anybody in the administration, in the Congress, in the Federal Reserve, whatever it may have been, FDIC, I can't imagine anybody saying, I'd like to be the one on television tomorrow and explain to the American public why we're keeping only $250,000 insured, and we're going to start a run on every bank in the country and disrupt the world financial system. I think it was inevitable.
But what's been interesting is that despite the US Treasury and the Federal Reserve stepping up and taking drastic action to protect the banking system, the concern hasn't really abated. It's still making headlines. It's still being discussed. It's still got a lot of people on edge. So with it now being May, I think a fair question to ask is,
what is your overall outlook on the banking industry?
The situation in banking is very similar to what it's always been in banking, that fear is contagious, always. And historically, sometimes the fear was justified, and sometimes it wasn't. My dad lost his job in 1931 because of a bank run. It used to be that if you saw people lining up at a bank, the proper response was to get into the line.
And without them knowing it at the time, this actually helped give the system a little bit of buffer time. Having to physically wait in line for money to be distributed bought bankers time to try and calm the situation and potentially figure out a solution. But that was then, and it certainly isn't like that anymore.
If people think deposits are sticky anymore, they're just living in a different era. You press a button. You don't have to get in a line and wait for days and have the teller counting out the money slowly in gold so that you hope the line goes away. You can have a run in a few seconds.
And that's exactly what we started to see happen at the banks that failed. Silicon Valley Bank had total deposits of $173 billion and saw over $40 billion withdrawn in just one day. These days, bank runs can be shorter and sharper, and this actually increases the risk of a single bank run turning into a fast-moving, panic-driven crisis. And this is where the FDIC is so important, an insurance company funded by all the banks to insure the first $250,000 worth of citizens' deposits so that if bank run mentality starts sweeping through the system, it won't turn into a panic. People will know that in most cases, their money is perfectly safe.
If you have people that are worried about whether their money is safe in a bank, and all trying to withdraw, you can't run an economy very well. So the FDIC was very logical. It's got changed over the years some. But here we are in 2023, and we actually see the FDIC pay off at 100 cents on the dollar to everybody, or make it available on all demand deposits, and yet you still have people very worried, and that just shouldn't happen.
It shouldn't happen, but it has. The FDIC is working as per normal. The Treasury and the Fed have stepped in and completely backed up the banks. But people around America are still feeling very worried about the stability of their financial system. And stay with me after I thank our Berkshire Trip sponsor Seeking Alpha, because Buffett is very quick to call out exactly who he thinks is responsible for this mess. Hamish and Brandon's Berkshire Bonanza 2023 is brought to you by Seeking Alpha. Try Seeking Alpha Premium today to access Seeking Alpha's rating system, valuation breakdowns, 10 years of financial data, unlimited news and analysis articles, plus have earnings call transcripts, investor presentations, SEC filings, and press releases all in the one place. With the suite of tools that come with Seeking Alpha Premium, you can be confident no matter what company you're looking at, you'll be able to get up to speed fast. But the best thing about our partnership is if you sign up with our referral link, you can access a 14-day free trial of Seeking Alpha Premium. So go check them out, give Seeking Alpha Premium a go for yourself, and now let's get back to it.
The messaging has been very poor. It's been poor by the politicians, who sometimes have an interest in having it poor. It's been poor by the agencies, and I'd say it's been poor by the press. I mean, you shouldn't have so many people that misunderstand the fact that although there may be a debt ceiling, it's going to get changed. Although there's a $250,000 limit on the FDIC and the U.S. government and the American public have no interest in having a bank fail and have deposits actually lost by people.
So Buffett quick to lay the blame on bad acting politicians as well as the media for essentially fear-mongering, which ultimately has blown this situation up into something that it really should never have been. But as Warren says,
that's the world we live in. It means that a lighted match can turn into a conflagration, or it can be blown out. And who knows what will happen. And we don't have any worry. We keep our money in cash and treasury bills at Berkshire because we keep $128 billion or whatever it was at the end of the quarter. And we want to be there if the banking system temporarily even gets stalled in some way. It shouldn't. I don't think it will, but I think it could.
But even though the media and fear-mongering politicians have escalated the panic around the banks in recent times, Buffett also takes the time to point out that this isn't the core issue which sparked the crisis in the first place. The fundamental cause of the issue, as it usually is with banking, is excessive risk-taking by management teams at a select few institutions. For example, in the case of Silicon Valley Bank, the initial worry stemmed from massive oversight of management to mitigate their interest rate risk. They bought a lot of government bonds at low interest rates with the intention on simply holding them to maturity, but as interest rates rose, the value of those bonds fell, and when investors started withdrawing their money, this meant the bank needed to sell down those bonds and realize large losses, which only compounded the issue. Worried that the bank was losing money, more and more depositors then looked to withdraw, which ultimately collapsed the bank. At the end of the day, this could have easily been avoided by the bank's management team, but they took unnecessary risks to chase higher profits. And the crazy thing is, in banking, usually there's no repercussions on the management team while the sky starts falling.
I think that the incentives in bank regulation are so messed up, and so many people have an interest in having them messed up. The way it hasn't been addressed properly is a problem, and who knows where it leads. But you'll have to have a punishment for the people that do the wrong thing. Hold the CEO accountable. The CEO gets the bank in trouble. Both the CEO and the directors should suffer. The stockholders of the future shouldn't suffer. They didn't do anything. It doesn't teach anybody any lessons or anything. It teaches the lesson is that if you run a bank and you screw it up, you're still a rich guy, and the clubs don't drop you, and the charity groups don't quit asking you to their benefits, and the world goes on. That is not a good lesson to teach people who are holding the behavior of the economy in their hands. So I think there's some work to be done, but I don't think it's not a difficult problem. It's just we've screwed up the answer and we've screwed up the communication of it.
I think a banker should be more like an engineer. He's more like into avoiding trouble than he is getting rich.
Yeah, and they could do fine.
They can do fine that way. And I think we made a big mistake when we create a bank where everybody who joins it finds to get rich.
Yeah.
It's a contradiction in values.
And this was one factor that led Buffett to sell down the vast majority of his bank stocks in recent years. But beyond that, Buffett also described at the meeting that another key reason he decided to sell was that he simply doesn't believe bank stock performance can be accurately predicted anymore.
We sold bank stocks in the last, well, we sold them first when the pandemic broke out, and then we sold some more in the last 6 months. And we don't know where the shareholders of the big banks necessarily, or the regional banks or any are heading. In terms of owning banks, events will determine their future. And you've got politicians involved. You've got a whole lot of people don't really understand how the system works. And I would say that you've had something less than a perfect communication between various people and the American public. So the American public is probably as confused about banking as ever, and that has consequences. You don't know what has happened to the stickiness of deposits at all. It got changed by 2008. It's gotten changed by this. I mean, and that changes everything. And so we're very cautious in a situation like that about ownership.
And I'm definitely going to sound like a broken record here, but this of course comes back to Buffett's rule number one of investing, which is don't lose money. If you can't predict with reasonably high probability where your business will be in 10 years' time, you can't really buy the stock. It becomes a gamble. So Buffett now thinks that thanks to politicians, fear-mongering, and the cluelessness plus irrational behavior of the general public, that generally owning bank stocks is too dangerous. But overall, that is Warren Buffett's explanation of the banking crisis and his outlook for the bank stocks. I hope you enjoyed the video. Please leave a like on it if you did and subscribe to see more videos. But with that said, I'll see you guys in the next one.